for TYBCOM Semester 5, organized by Department of Commerce, S.S.T College of Arts and Commerce. Crash Course series provides you with a better opportunity to revise all the important topics and key concepts that one has studied during exam preparation. Since TYBCOM Sem 5 offline exams are approaching after a great interval of pandemic period, this series is going to be helpful for preparation of exam. Today, the first episode of Crash Course series on financial accounting, and to conduct this series, we have a very knowledgeable person among us. She is having experience of this subject for many years. I would like to welcome Assistant Professor Lakshita Soni ma'am from BK Birla College of Arts, Science and Commerce. Ma'am is a faculty of ICAI for Orientation Training Program. Ma'am is a faculty of accounts for Kalyan Ambarnath chapter. She has also presented many research papers and co-authored many books. There are everlasting list of achievements of Lakshita Soni madam. Thank you very much, ma'am, for accepting our invitation to impart your knowledge for our students. I will request ma'am to start the session. Over to you, ma'am.
Thank you so much. Thank you. Thank you so much, the organizers, for giving me this opportunity that I can come and share my knowledge and facilitate students who will be appearing for their final examination, semester 5. So with all my best wishes and warm regards to the college authorities and dear students, I commence my session. And according to me, financial accounting is indeed the most interesting subject and the most comfortable subject. Students, do you agree, yes or no? You can just put your yes or no in the chat box. Are you comfortable most with financial accounting, yes or no? Because I will give you reason why I say you should be more comfortable with financial accounting than cost or tax, because this is some subject through which you were acquainted with commerce field. So right from grade 11, standard 11, actually you are dealing with the subject. Only thing is this is subject keeps on progressing, and with every year new topics keeps on coming, and then accordingly your knowledge keeps on adding. So here we come to your TY semester 5. You will be writing the paper for 100 marks. I will very briefly discuss with you the paper pattern. You will be writing the objective type questions for 20 marks, followed by which you will have practical questions for 20 marks, and the last question will be your theory for 20 marks again. So you will be attempting 5 questions, each having weightage of 20 marks. So you will be basically solving the practical problems, as well as you will be presenting your knowledge, your theoretical knowledge that you have learned through these practical problems in the last question. So basically you don't have to, students, you know, they worry a lot that ma'am theory mein kya likhna hai, kya nahi likhna hai. So you don't have to worry. Whatever you are going to write, practice, जो problem solve करोगे आप, right from chapter number 1, which is final accounts of companies, to internal reconstruction, to buyback of shares and investment accounting, you are simply going to apply that the practical knowledge you're going to write down in sentences and give answers to short notes. So I've taken the most comfortable and loved topic by the students, that is buyback of shares. So let me give you a very brief on buyback of shares. Why do we do? What are the reasons, and what exactly you're supposed to do in buyback of shares? So basically, buyback of shares, students, it's a process of capital restructuring. Companies, they undergo restructuring, they restructure the capital structure, and the reasons and objectives can be they want to enhance the earning per share, they want to enhance the intrinsic value of share, they want to maybe that they want to reduce the unnecessarily inactive share capital, so they want to reduce that excess capital, they want to increase shareholding of promoters. So there may be various reasons that why they intend for capital restructuring. These are the reasons, these are the objectives why they go for buyback of shares. Of course, buyback means they purchase their own shares. Okay. So this will definitely reduce the number of the shares or the share capital with the company. Then when we study buyback, we have to keep in mind that Section 68 regulates, controls the entire procedure for buyback of shares. The students, a related topic you all have already covered in your second year BCom, that is redemption of shares. Most of the times, these two terms are oftenly considered similarly also, and oftenly there is a lot of comparison that goes. So let us understand what is the difference between the two. Any shares can be bought back, that is equity shares or preference. But when we talk about redemption, it is only preference shares that they can be redeemed. Then, as I said, that their Section 68 governs buyback of shares, whereas Section 55 governs the procedure for redemption of shares. Okay. Now, for redemption also, if you remember, there are sources through which we carry out redemption. Those sources were, you can utilize your divisible profits, your accumulated profits, or you can also go for fresh issue of shares. Here also, the sources are listed, which includes free reserves, that is divisible profits, and security premium. Okay. But what is the difference between two? Redemption of shares, there you ignore the date of issue, you know the date of redemption. But in case of buyback, the date is not known. It depends entirely on the company when they want to restructure their company's capital structure. So students, you must remember the clear differences and the similarities between the two, and you can definitely expect some kind of short note coming on the distinction between buyback and redemption of shares. Definitely this will help you to understand the concept properly. Now, as I said, Companies Act governs this Section 68. So let us understand the steps. The first step is that you should know what are the sources of buyback. What are you going to do? Are you going to use your free reserves? Or you can also use security premium in addition to free reserves. Also, if the company wants to issue new shares and organize and wish to issue the amount of cash for buyback of shares, they can also resort to third option, that is they can go for issue of any shares. Okay, but here you have to remember, if you want to go for buyback of equity shares, you cannot issue equity shares. You can only issue preference shares. So you cannot have issue of same shares with the one that you're going to buy back. Secondly, this authorization is important. So again, if the theory question is coming on state the legal provisions for buyback, you can present in the similar pattern. These are the sources. Then authorization. Authorization includes that there should be provision in articles of association. Then this is to be discussed in the board of directors meeting. And if it is within 10%, then they will resolve there itself. But if it is more than 10%, then the same has to be done through special resolution, which is required. Shareholders has to pass if it is up to 25%. Okay. There is one more condition for buyback, that shares should be fully paid up. Along with that, buyback needs to comply one more condition. And the condition is that company has to check debt equity ratio. They have to ensure that after buyback, the ratio should be 2:1. Okay. So they have to check ensure proper balance between debt capital and own capital. When we are talking about debt capital, we are talking about secured and unsecured long-term debts, or we also called it long-term borrowing. So they have to maintain that balance. Then you have to also make sure that the time gap between two buybacks should be within 1 year. Okay. So that, it should be a period of 1 year. Within a period of 1 year, you can execute buyback. You cannot cross that limit. Okay. Then you have to also mention in the explanatory statement that why this buyback is carried on, what are the shares which are required to be bought back, what is the time limit, etc. Then I'm coming to methods of buyback. Because how will you buy back? From where you will you buy back? Either the shares can be bought from the existing shareholders, or you can do so from open market or from the employees. That is the shares which were issued to them under ESOP or sweat equity scheme, etc. Now, these are other certain conditions which are to be complied with when we are talking about buyback of shares. Necessary regulations, necessary steps to be carried out. Registrar of companies is to be informed. A register of buyback is to be maintained. So these are certain conditions, time limits, which are to be duly fulfilled when we are talking about buyback of shares. So remember, Section 68 is giving all the legal provisions for buyback. Then the punishment, that a company shall be punishable with fine not less than 1 lakh rupees, okay, in case they default for the execution of this particular thing. Now I'm coming to the practical aspect. That is, when we execute buyback, we have to make sure that if the buyback is out of free reserves, or we are utilizing our sources like free reserves, divisible profits, or security premium, then we have to make sure that equal amount of that buyback, equal amount of nominal value of shares which are to be bought back, is to be transferred to capital redemption reserve account, which is normally called as CRR. So if you are utilizing your free sources, you're utilizing your free reserves, security premium, you have to transfer the amount to CRR, and that CRR can only be used for issue of fully paid up bonus shares. So these are the conditions which you need to understand. And remember, SEBI guidelines, we will just quickly go through, because more or less we are following the guidelines which are issued by Companies Act. Section 68 is to be followed. I'm just keeping it a glance. You can just quickly go through. So SEBI has also issued the regulations for buyback of shares. Okay, then this is a procedure which is mentioned. If you will visit the website of Corporate Affairs and the Ministry of Corporate Affairs, there you will get the entire procedure for buyback of shares with the methods, what are the steps which are to be carried out pre-offer, and during and post-offer, what are the steps which are to be carried out. Now, let me take you to journal entries, accounting entries that are required. As I said, the first condition is you cannot buy back partly paid shares. So step number 1, you will see whether shares are fully paid or not. Otherwise, you will pass an entry for making the shares fully paid. You will write the entry for the final call. In addition, if company wants to sell its investments or certain assets for arranging the cash flow for buyback, they can do so. And in case company is selling any investment at profit or loss, you have to pass the entry for sale of investment. That is, bank account will be debited. In case of loss, loss to be debited. Profit, profit to be credited to investment or any asset account. Now, the process of buyback will start with transfer of amount. You will have to transfer the amount that you have to buy back from capital to shareholders account. Since this capital is bought back, it is not required. It will not be a part of your balance sheet. So you will debit this particular amount and you will credit the same amount to shareholders. Sometimes buyback will be on premium. So premium on buyback of shares will also be debited. So suppose the face value of equity shares is 100. You want to buy back it at premium of 10%. So that premium price will be added to capital, and that amount 110 rupees will be paid to equity shareholders. So before executing the process, you will write the entry for transferring amount to shareholders account. Then you will follow these steps. You want to issue share capital. So for equity buyback, you will issue preference shares. You will write down the entry for issue of preference capital. Then you want to create CRR because you want to utilize your divisible profits, transfer the amount from divisible profits to CRR, and accordingly create CRR. Subsequently, if buyback is on premium, that premium is to be written off. What you can utilize for writing of premium is your security premium. In case that is insufficient, you can also utilize your divisible profits like profit and loss or general reserve. To complete this process, you will make the payment to equity shareholders by passing the entry shareholders account to bank. Because if you remember, the first entry that we started for buyback, equity shareholders account was credited. Here, you will debit this account and you will pass on the amount to them. Okay. Now, when the buyback happens, there are two options that in the question, they may give you the offer price at which buyback is happening. As I said, the face value of shares is 100 and buyback is executed at 120. It means the offer price is very well mentioned. Now you need to understand that how you will compute maximum possible amount of buyback. For that, you will have to prepare a statement of computation of maximum possible amount of equity shares. You will list down your sources as I told you. You will check the source test, that is minimum 25% of own funds. So you will check that condition where whatever reserves and surplus you have accumulated, you will add preference and equity capital to it, and 25% of that will be treated as own funds. Okay, so that will give you condition number 2. Condition 1 ka answer you will list separately. Condition 2, where you will take out 25% of own funds, you will keep separately. Condition 3 is minimum own funds after buyback. Minimum own funds after buyback, I told you they have to maintain the ratio of 2:1. So own funds minus 50% of debt will give you answer to condition number 3. Condition number 4 will be 25% of paid up equity shares. We know the offer price, so we will calculate the number of shares, 25% of equity shares. We will divide it, we will multiply it with the offer price given. So with the 25% of equity shares, when you multiply, you will get the amount of paid up capital. 25% of paid up capital with offer price, that will give you answer to condition number 4. With these least of above 1 to 4 amount, you will treat as maximum, the amount which is least of 4 amounts. Sabse chota amount, you will treat as maximum possible amount of buyback. When you divide it with offer price, you will get number of shares. So this computation will lead you to ascertaining the amount and the number of shares which will be bought back at a given offer price. Now, there will be a condition, maybe they do not give you offer price. So when offer price is not given, what is to be done? In case the offer price is not given, we will repeat the first 3 steps as discussed earlier. First 3 steps as in, first step, you will write down all the sources. You will get amount 1. You will write down 25% of own funds. You will get amount 2. You will write minimum own funds, get amount 3. Now here, since you do not have offer price, so least of first to 3, we will treat it as our amount of buyback. Once you get that amount, you will divide that amount with 25% of equity shares. When you divide that, you will be getting your offer price. So that is how you compute the amount for buyback and the offer price when offer price is not mentioned. So dear students, these are most important aspects for buyback of shares, most important ones. Here, as I told you, this you must remember that this is a process of restructuring where you buy own shares of the company from his existing shareholders. Okay, this is also known as buyback of share stock. Which section is applicable? Section 68. What are the objectives? We should know. The primary objective being that they want to use the surplus cash. They want to increase earning per share and intrinsic value of the share. There are points which will clearly distinguish buyback and redemption. So we understood the difference between the two. And then we understood what are the legal provisions. We understood what are the legal provisions as well as the accounting entries for buyback. Now I will take you to the next topic, which is internal reconstruction. That is your second important topic, internal reconstruction. We just talked about capital restructuring in form of buyback. But in addition, sometimes the companies undergo reconstruction of the entire financial situation, financial position. They have to undergo reconstruction of capital. They have to revalue assets. They will have to revalue their liabilities. Why? Because maybe perhaps the company is not performing well, the company's financial situation is not good, and there are continuous losses in the company in last few years, and they have accumulated losses to the asset side of their balance sheet, and there are fictitious assets which are getting added and intangible assets which are not even valued in few years. So in that condition, they will have to write off these fictitious assets. They have to write off these losses and intangible assets which are not even revalued in quite a good period of time. So they have to reconstruct the financial position of the company. They have to convert a sick company, unhealthy company to a healthy company. What they will do? So they have to present final accounts in their true and fair, at the true and fair value. So because since losses are there, capital is also not reflecting its true value. There are many liabilities which are not paid. Yeah, the reconstruction of company can be of two types, which is internal reconstruction or external reconstruction. Internal reconstruction we will be covering here. External reconstruction as a part of syllabi we will be covering in next semester. Now, internal reconstruction, definitely we are not liquidating the company. We are not shutting it down. We are not forming a new company, whereas it is happening. So with external reconstruction, you go for new formation. Here you are not taking over business of existing company. You are very much continuing the existing structure. And this is governed by Section 66 of Companies Act. With external reconstruction, the rules and regulations and code of conduct is different. And there is a separate act which is governing external reconstruction. As of now, we focus on Section 66 of Companies Act for internal reconstruction. Let us understand the methods of internal reconstruction and the accounting treatment. When we talk about methods, we need to understand there are 3 to 4 important methods the way you reconstruct the company. First being reduction in capital. What you do is you try to reduce the capital of the company and you try to take that capital and utilize that amount for perhaps paying liabilities. So one way is you reduce nominal value of the company. When you reduce the nominal value, there is no reduction in the paid up value. So balance sheet amount of share capital will not change. Only the nominal value will change. In this case, because nominal value changes, you will have to present the new nominal value in the balance sheet now. So you will write down old now capital account debit to new capital account. Old being example 100 rupee share and new being example 80 rupee share. Second condition can be reduction with paid up value only. You only want to reduce the paid up value. Don't want to touch the nominal value. Now, since the amount you have already collected from shareholders, you want to reduce that amount, you utilize that by transferring that amount to capital reduction. Students, understand this is an internal reconstruction. You're doing everything to make a company healthy. So you need cash. So whatever adjustments you will be doing, you will create an account, temporary account, which is called as capital reduction account, and you will transfer the amount so adjusted in that account to write off liability, to pay liabilities, to write off the fictitious assets, and to write off the losses. Now, third method being, when you reduce the capital, you want to reduce both. So once and for all, you want to reduce the paid up value. You also want to reduce the nominal value, and hence the amount so sacrificed by shareholders will go to capital reduction. Okay. So this is the method wherein you go for reduction in capital. Reduction will also have impact. The fourth condition will be, maybe you want to ask the surrender of shares. You want to ask your shareholders to surrender the shares. So in that case, you will debit that share capital and you will transfer the amount of share surrenders account. For cancellation of surrendered shares, you will cancel the surrendered shares, so transferred from capital to surrender, and give the amount to capital reduction. Further, you can also reissue surrendered shares. So first, you will ask shareholders to surrender the shares, then you may reissue or you may cancel. When you cancel, you transfer that amount to capital reduction. I'm coming to second method, alteration. What happens in alteration of share capital is you will alter the capital of the company. When you alter the capital, you will make structural changes in the capital. You will make structural changes in the capital, like the share which was earlier of ₹10, you will convert that share of ₹100. So you are basically, what you are doing is you are consolidating the number of shares. You are reducing the number of shares. So in such case, the entry will be old capital to new capital. That is capital with old value, nominal value, and capital with new nominal value. So that is alteration of share capital. Further, we can also go for subdivision. It depends on the requirement of the company. What is the objective with which company wants to make changes in the capital structure? If they want to multiply their shares, they will go for subdivision. If they want to reduce the shares, they will go for consolidation. Subsequently, they may also cancel the shares which are not to be issued, unissued shares, which will have no impact on your books of accounts, or they can convert shares into stock or stock into share. But I suggest students in internal reconstruction, definitely you can expect an entry to be required to be passed on reduction of capital, entry on consolidation or subdivision. So you must focus on consolidation or subdivision as an important aspect. Now, other than reduction of share capital, method 1, reduction, method 2, alteration. Now we are going to method 3, which is variation of shareholders' rights. When we talk about variation, we may request our shareholders to maybe reduce the dividend, rate of dividend. So we are asking them to compromise their income, which they will be getting. From 12%, we may ask them to go to 10%. So that will have no effect on the amount paid up value, but only it will create the effect in the nomenclature of the capital. We may ask them to convert to other class of shares, non-cumulative to cumulative, cumulative to non-cumulative. So this will be also an arrangement. That will be the arrangement with shareholders. Now we are talking about compromise and arrangement with respect to our assets and liabilities. We can go for revaluation. With revaluation, it is possible that the asset will appreciate or depreciate. If there is appreciation, you will debit the asset account and you will transfer the amount. So the increase in the value of asset will be transferred to capital reduction. So students, with every entry, you must remember that are we saving something? If we are saving something, transfer it to capital reduction. If we are giving more than what was there, we have to debit the capital reduction. So you have to see that particular method, whether it is resulting to any change in capital reduction. Because at the end, you are expected to prepare a capital reduction account, and towards the end, you will have to also analyze if there is any balancing amount which is there in the capital reduction account. So these are the arrangements which are required at the assets level, wherein you must definitely remember revaluation of assets. You will expect 1 or 2 adjustments on appreciation and reduction in the value of asset. You must read the adjustment given very thoroughly to understand whether the effect is resulting in appreciation or the result is effect is resulting in reduction. Similar is the case with liabilities. In liabilities also, you will understand if the liability is increasing, then you will have to pay off that amount and you will have to debit capital reduction. If the amount of liability, creditors, etc., they are sacrificing their share, so liability will decrease. Then if that case, liability is decreasing, capital reduction account will be credited. So these are few other adjustments where some external liability or some asset is being taken over. They are also to be adjusted through capital reduction account. Then, if there is some liability which is to be satisfied by issue of share capitals, for example, creditors are partly paid by issue of shares and they are paid with premium. So that will be the entry where you will write down the settlement of liability by issue of debentures, by issue of shares, etc. Now, there is oftenly an adjustment which is asked that there were arrears of preference dividend. Now those arrears are waived. Arrears of preference dividend, students, you will remember this particular topic, this particular aspect is contingent liability. We do not record in the books of accounts. We record it as a footnote. Okay. So if you are waiving of that liability, अगर arrears pay नहीं करने हैं, तो हम लोग ने books में तो वैसे ही record नहीं किया, तो उसकी entry नहीं लिखेंगे. But अगर आप record कर रहे हो, arrears को pay कर रहे हो, कुछ कर रहे हो, so then you will debit capital reduction account. And then you will pay to preference shareholders that amount. Ultimately, as I said, towards the end, you will have to make sure that you are utilizing capital reduction account for various purposes. That purpose can be, I want you to pay attention to this entry for write-off intangible assets, fictitious assets, and losses. Whatever amount you will have accumulated so far in the capital reduction account by way of alteration, by way of compromise, arrangement, reduction, all that amount that you have credited to the reduction account, now you can utilize it. You can utilize it for writing of goodwill, patent, copyright, which you couldn't write off because of non-availability of profits. You write off your fictitious assets, which you couldn't write off earlier, and which are creating the nuisance value to your balance sheet, and they are not actually presenting your balance sheet at true and fair value. So write off the losses also that are lying on the asset side of your balance sheet since so long. And then towards the end, you will transfer the balance. If there is any balance left in the capital reduction account which is not utilized, which we are having in surplus, so we will close that account because we don't want to continue reduction account. Reduction was a temporary account which was created for internal reconstruction. Reconstruction ho gaya, losses write-off ho gaye, intangible assets write-off ho gaye, now you close it and transfer that amount to a reserve which is called capital reserve. So remember, capital reduction account, when you close, any balance which is left, it will go to capital reserve account. So this was all about internal reconstruction. I've given you the base. I've given you what are the important methods. I've given you the introduction, told you what you mean by internal reconstruction. Okay, we have seen the difference between internal reconstruction and external reconstruction, and we have focused on the methods of internal reconstruction, right from reduction to alteration, to variation of shareholders' rights, to compromise and arrangement, and then ultimately, how are we going to utilize this amount in capital reduction? We have also seen. And towards the end, you will close reduction account and transfer the amount to capital reserve. Ma'am, are we taking questions simultaneously from students? I mean, I'm open to that if they want to.
Ma'am, after the end of
Okay,
session.
sure. Okay,
Hello.
so I'm taking you students to the next topic, next important topic. Just a minute. So the next important topic that you have is investment accounting, which is with reference to accounting standard 13, which deals with accounting for investments. Students, so far we have covered two important topics: internal reconstruction. Then we have seen the procedure, accounting treatment and procedure for internal reconstruction, for buyback. And now I'm coming to investment accounting, which is the scoring topic, wherein you have to prepare investment account. You have to show the various adjustments with respect to the investments which you are holding and the further transactions which occur during that particular accounting year for which you are preparing investment account. So let us understand what type of investments are there, what type of investments do we have to deal with as we learn the accounting for investments. When we talk about investments, investments are held for earning income. When we talk about investments, we are looking for return. So return can be in form of dividend, interest, or rentals, etc. Of course, we will further classify this return in fixed return and variable return. But let us understand what are the most important factors that you consider while making investments. As we make investments, there are three important factors. We, of course, take care of liquidity. We would like to know when our investments will liquidate. Can we convert them into cash whenever we require? Two, are my funds safe? It means safety of funds that I've invested. Three, are these investments going to lead me some profits in future as well as in the current period? So it means profitability means to earn profits from that investment. These are three factors which form the basis for any investor: liquidity, security, profitability. Now, AS 13 states that when we talk about investments, there can be investments that you classify on the basis of period of holding. If you're going to hold the investment for a period of more than 12 months or 1 year, such investments are called as long-term investments. And if you're going to hold them for not more than 12 months or 1 year, such investments are short-term investments. You already know how we present long-term investments and short-term investments in Schedule 3 balance sheet. Second classification is on the basis of return. What kind of return am I going to get? Am I going to get variable income, that this income is not fixed? It varies from period to period. It varies on it depends on certain aspects, that is like profitability. It depends on whether the company is earning sufficient profit. It depends on what number of shares I have. It depends on what period I'm holding those shares. So there may be factors because of which my income will vary. So if my income is not fixed, the date for receiving income is not fixed, that income, that investment is known as classified under this category, variable income bearing securities. But on the contrary, if the date is fixed, if the rate is fixed, then my income is fixed. And then that particular investment is categorized under fixed income bearing securities or earning securities. Example, that you invest in debentures, you invest in bonds, you invest in government securities, etc. So where the interest is provided to you at a fixed rate and on a certain due date. So till that due date, your interest will accrue because your interest will be paid on a specific due date. Then this interest that you earn is further can be classified as interest, which is cum interest, that is with interest investments, or investments that you purchase or acquire without including the amount of interest, that is X interest investments. When we pay price, we have to ascertain that under which category are we coming. Are we paying the price of investment inclusive of interest? This is called as cum interest price. That is when the investment is purchased, it includes the amount of accrued interest. Accrued interest, I told you, outstanding interest. Outstanding interest means आपका interest due date पे जो मिलने वाला है, last due date से आपकी due date जो next आएगी, so it is getting accrued, आपका generate हो रहा है, outstanding आ रहा है. So when you purchase, you pay price along with interest, it is cum interest. And when you purchase, you do not pay interest along with it. It is not covered in the cost of investment, it is X interest. So if interest का price cost of investment में included है, if cost of investments include outstanding interest, it is cum interest price. And if it is not included in cost of investment, it is X interest price. Interest is very important. Interest calculation is very, very important when we talk about valuation or accounting for investments of fixed income bearing securities. Because the entire calculation will revolve around these two terms. So you will have to understand carefully whether the interest, the investment that you have purchased or you have sold, whether that investment is at X interest or cum interest. If the price is X interest, we can directly write down that X interest price in your cost column. But if it is cum interest, we will have to find out the amount of accrued interest and write it separately after deducting it from the amount of investment. So let us understand the process. Along with interest calculation, there is one more important calculation that students have to keep in mind. That is, with every sale of investment, you will have to find out profit or loss on that sale. And AS13 states that the method which will be used for evaluating the cost of investment will be weighted average method. So let us understand the formulas for calculation of accrued interest and formula for calculation of weighted average cost. Accrued interest, that is outstanding interest. Outstanding interest will be recorded at every transaction when we record debentures or bonds or government securities. That is, I'm talking about fixed income earning securities. So that amount of accrued interest will be calculated by using this formula. Students, this formula is very important for you. Accrued interest का calculation अगर right है, तो your entire problem का base is right. So you will find out nominal values of securities held. आपके पास उस दिन तक कितने securities हैं, उसका nominal value क्या है? Multiply by with percentage of interest. Of course, 10% interest है, तो multiply by 10 upon 100. 8% rate है, तो 8%, whatever coupon rate is given. And then you will take the period for which this interest is accrued. Outstanding इतने months का है. तो outstanding कितने months का है, उसके लिए हम कौन सा period लेते हैं? Between last due date to that date of purchase or sale or opening or closing. So last due date to the date of purchase or sale will be the period for calculation of accrued interest. For calculation of weighted average cost, you will take in hand the number of securities sold with the number of securities you have on that day of sale. You will compare कितने sell किए, कितने available हैं with net cost. Proportionate amount you will get as weighted average cost of investment. And ये weighted average cost को जब आप selling price से compare करते हो, तो you get final profit or loss. Now let us see what accounting entries do we have to pass. When we purchase the investments, you will have to write an entry for purchase of investment. So purchase investment, investment account is debited, interest is debited, and the bank is credited. For sale of investment, your entry will be reverse. With sale, you will record the entry for profit or loss, and you will transfer profit or loss to P&L account. When the interest is due, you will record the interest bank account to interest account. Please note that the interest due is given for what period? Generally, it will be twice a year. So, of course, when you record the entry for interest received on due date, you will consider 6 months in calculation. So for 6 months, you will record the interest, and generally in a year, this entry will come for this entry will be recorded twice. Finally, whatever interest is there, you will find out the balancing figure and transfer the interest to P&L account. And towards the end, you will also find out valuation of closing balance of investments. If market value is given, market value or cost, whichever is lower, accordingly, you will take the value of investment. And with this, if there is any difference in the value in the closing balance of investments, that loss will be transferred to P&L account. This is how your investment account looks like, with the nominal value, with income and cost, opening purchases on the debit side, sale reflecting interest received on the credit side. If there is profit on sale of investments, debit, you will debit it. If there is loss on sale of investment, you will credit that amount. Subsequently, interest account close करेंगे, last में जो amount है वो P&L में transfer करेंगे, and closing balance पे अगर कोई loss आ रहा है, तो that also we will transfer to profit and loss account. So that's all about accounting for fixed income bearing securities, under which we consider debenture, bonds, government securities. Now let's come to accounting for variable income bearing securities, for example, equity shares. Now, when we talk about equity shares, these equity shares, they have variable income. The rate of dividend is not fixed, nor is the date of dividend fixed. When rate and date both are not fixed, when it is going to accrue, it is not accruing. And hence, whatever dividend is proposed by the company, we don't even record in the final account. Schedule 3, Chapter 1, you know that. हम लोग balance sheet में नहीं दिखाते हैं proposed dividend, we record it as contingent liability. So, accrued जैसे interest record होता है, dividend नहीं होता है. Here, the calculation is much simpler. If you purchase shares, shares account will be debited, amount will be credited. In this, you will consider two important aspects. Number one, you will consider the valuation. Number one, you will consider the calculation of bonus shares. And number two, you will consider the calculation of right equity shares. These both calculations here. So the calculation of bonus shares, we all know bonus existing equity shareholders. Same is the case with right shares. Right shares are also allotted to existing equity shares. Bonus shares, they are not recorded as cost because they are offered to existing shareholders without any cost, free of cost. And for right shares, of course, they carry a price which shareholders have to pay, but it is entirely upon the existing shareholders. They want to subscribe the shares or they want to sell. If they want to sell the right shares, directly the amount of profit or loss is credited, the amount of profit is credited to P&L account with having no effect on investment account. But when we talk about shares, the calculation of dividend is important because dividend is declared in the current year for the last accounting year. So the investor who is holding the shares for last accounting year, that amount of dividend is directly credited to dividend account. I mean, in the investment account, in the dividend column on the credit side, which is your dividend for post-acquisition period. Because already you were holding those shares for entire year in the last accounting year. But shares which you have purchased or acquired in the current accounting year, on those shares, when you are getting dividend, is called as pre-acquisition dividend, and that pre-acquisition dividend is shown in the cost column of your investment account. So here your calculation needs attention, that you classify the dividend in pre and post. Pre-acquisition dividend, you will transfer to your cost column. Post-acquisition dividend, you will transfer to your income column. Accordingly, you will also make sure that the shares are classified properly between bonus shares, between right shares, and the ratio in which bonus shares and right shares are issued. It also needs attention. What is the ratio? Ratio in which these shares are allotted. So let us understand once again. I want you to pay attention on the calculation of dividend because these are important points. Shares held on the opening date of accounting year, यानी कि जो आपके opening balance के shares हैं, वो जो shares हैं, उस पे आप जो dividend calculate करते हो, वो आप dividend column में दिखाओगे. Newly purchased shares, जो उसमें आएंगे हम लोगों के shares, जो न्यू परचेज किए हैं वो हम लोग जाएगा उसका डिविडेंड इन द कॉस्ट कॉलम. Whenever you are calculating bonus shares or you are calculating the right shares, you will calculate that number as on that date. As on that date, आपके जितने shares held हैं उसके ऊपर वो ratio लगेगा and you will calculate bonus shares and right shares accordingly. Okay, I repeat, post acquisition dividend is the dividend received on ओपनिंग डेट ऑफ अकाउंटिंग ईयर. जो शेयर्स ओपनिंग डेट में थे उसका जो डिविडेंड होता है वो पोस्ट एक्विजिशन होता है. अदर देन दैट जो डिविडेंड आपको मिलता है और द शेयर्स व्हिच आर न्यूली परचेज्ड, इट इज प्री एक्विजिशन डिविडेंड. राइट इश्यू, इट इज इश्यूड टू एग्जिस्टिंग शेयर होल्डर्स. रेशियो इज इंपॉर्टेंट. नंबर ऑफ राइट एंटाइटलमेंट्स, कितने ऑप्ट कर रहा है शेयर होल्डर. इफ ही इज ऑप्टिंग फॉर 60%, 60% प्राइस उसका डेबिट हो जाएगा. If he is opting to sell remaining to outsider, पूरा का पूरा profit will be transferred to profit and loss account with profit on sale of rights 1600. For example, in like here we have taken one example. Total 2,400 right shares were given. Out of that, how much they have? How much number of shares which are subscribed? Out of 4,000, out of 4,000, 60% were subscribed. And 40% was sold. So 40% shares जो सेल किए 1600, ₹4 per share पे हमने सेल किया है, तो 1600 into 4, the entire amount is credited to P&L account. So this is how your investment in shares will look like. These are important calculations as far as AS, this investment accounting is concerned. So you have to understand, read whether you are required to prepare investment account for fixed income bearing security. Debenture का पूछा है, तो interest calculation becomes very important. Equity shares का पूछा है, so your dividend calculation becomes important. And with this calculation also, you will have to calculate the profit or loss on sale of securities as per weighted average method, which is defined or governed by AS 13. Now, let me quickly take up, show you a small question bank that I have prepared for theory questions. And then I will open the forum for discussion. Yeah, so these are some theory questions for chapter 1, company final accounts. Company final account students, you have to stick to schedule 3 format. Your classification will help you to earn marks. So you go through all the headings, all the classifications, stick to that accordingly, and the important adjustments with reference to chapter 1 is relating to tax. You will have to compare the provision for tax and advance tax for current year and the last year, and accordingly you have to write them in the right schedules and then transfer it back to your original formats. So here you must know the classification of current liabilities, you must know the contents of current assets, you must know how to disclose reserve and surplus, you must know the disclosure of tangible assets, you must know the disclosure of share capital, right from authorized capital to subscribed to issued to paid up. How are you going to write this share capital in the balance sheet? You must know the contents of long-term borrowings, which borrowings are classified as long-term borrowings. You must know the disclosure of cash and cash equivalents and the difference between trade receivables and payables. These are some questions that I've shortlisted that you can refer as theory part for your chapter 1. Chapter 2, we have discussed most of the things. What do you mean by internal reconstruction can be expected as a long-term, long type question. Then why do we go for internal reconstruction? What is the format of capital reduction or reconstruction account? Difference between consolidation and subdivision, I told you. These are important methods through which you reconstruct the capital, alter the capital. Then what are the different ways of alteration of shareholders' rights? Then we have next chapter is buyback. So of course, I told you the conditions of buyback are listed properly in the Companies Act. So what are the legal provisions? What is the maximum limit? Then you will write down what are the sources of buyback of shares, I told you. And what is the debt equity ratio that we need to maintain? How will you calculate that debt equity ratio? Give the classification between divisible profits and non-divisible profits. When we are talking about investments account, investment accounting, the questions expected can be, what are the different types of investments, classification of investment. We discussed about pre-acquisition, post-acquisition dividend. So what is the difference between two? How it is treated in the books of account? Which one is capital receipt? Which one is revenue receipt? Then X interest, cum interest transactions, you will have to write down. You have to give with example, give calculation, show short calculation in your long-term, long answer type questions. And then we are coming to the last module, that is ethical behavior. These are important questions that you should go through. We know that ethics play an important role when we talk about accounting environment and corporate accounting. So what are the different types of ethics? What are the important principles of professional ethics? What are the components of ethics in workplace? Okay. And there are certain concepts which are explained. like every company has to contribute towards social responsibility in form of CSR. So what is the accounting treatment of CSR and the necessary provisions for CSR? Then whistleblowing as a concept, that once somebody from the as an insider of the company, they want to reveal some important information for the benefit of the company, then that particular aspect is called as whistleblowing. So how it takes place, who is whistleblower, are there some conditions? Give one case study which is explained, the latest case study if you can highlight of whistleblowing. And finally, what is the need of ethics in accounting and finance? So these are some short type of questions that you can refer in the final module, where you have to understand ethical behavior in accounting and finance. So dear students, with this I conclude, and with this also I am open to discussion and questions from your end. I think I have taken 10 minutes extra, but madam, it is very difficult, to concise 4 big modules in 1 hour. I know I could have, for chapter 1, if you give me 1 hour, that is itself is incomplete, but I'm available. You can definitely ask students to reach out to me anytime they want to connect with me. You have my contact details.
Sure, ma'am, definitely. But you have justified your explanation. I must say, you have done the justice to your subject.
Thank you.
Ma'am, may we go with certain questions?
Sure.
There is a question. Students have asked that why do companies undergo internal reconstruction?
Okay. So companies undergo internal reconstruction because perhaps the company was not doing well financially in last few years. So they have suffered losses. They want to reconstruct. They want to rely on their abilities. Okay. They want to reconstruct their capital structure. They want to reconstruct their financial health so that they come back as a sound company. So instead of going for liquidation, they don't want to wind up their company. They want to survive and fight back. So they want to go for internal reconstruction.
There is another question. What is conversion of shares to stock means with reference to internal reconstruction?
Yes. So when you convert shares to stock, it means basically what you're trying to do is from small securities, you want to build up a stock. So you are basically consolidating your small scripts to a stock. So you are consolidating the small portion of share to a bigger portion, which is treated as a stock, investment stock.
Okay. Thank you, ma'am. Thank you very much for such an important session. And even though, as you said, ma'am, in the beginning, that even though students are acquainted with financial accounting concepts right from the 11th standard, but this is the most technical subject in commerce. The student find it quite difficult and challenging when it comes to appearing for exam. And
so, this was the reason why I told them this is the most easiest for you, because you are doing it right from 11. So you don't treat it as difficult. You treat this as most comfortable subject. In fact, cost and tax are new for you. This is your friendly subject.
This is friendly subject. The concepts are already known to the student. And your session was so lucid, and the concepts you explained were in so simple terms that now student must have found the concept simple, and they have solved. It has helped them to solve their difficulties. So I must say that you have covered all the important aspects of the subject through this crash course series. Once again, I thank you on behalf of S.S.T College of Arts and Commerce for sparing your valuable time and delivering such a important session for all the students. I take this opportunity to thank management of S.S.T College of Arts and Commerce for supporting such informative sessions. I also thank Founder Principal Dr. J.C. Purswani and IQSC Coordinator Dr. Khushbu Purswani for the idea behind this program. I thank Department of Commerce for organizing such an important session, which is going to be helpful for all the commerce students for appearing the offline exam. I also thank all my colleagues, technical staff, as well as the administrative staff for helping for helping to organize this event. And last but not the least, thanking all the students to attending the session. Thank you.
Thank you. May I leave?
Yes, ma'am.
Thank you so much. Thank you.
Ma'am, you have to end the meeting because you're host.